If you've ever wondered why the rich get richer, it's not luck, it's compounding, the one law of wealth that rewards the patient and punishes the restless. That single sentence captures one of the most misunderstood truths in all of finance. Everyone wants to build wealth, but almost no one understands the quiet math behind it. Because compounding isn't a trick or a formula, it's a philosophy. It's what happens when discipline meets time. Benjamin Graham knew this long before calculators or trading algorithms existed. While the world tried to outsmart the market, he tried to outweight it. He realized that the real magic in investing doesn't come from predicting the future. It comes from staying calm long enough to let arithmetic do its work. Compounding is what happens when your money stops, depending on you, and starts working for you. The problem is, most people never give it the chance. Imagine two investors. Both start with $10,000. Both earn the same average return, say 10% per year. The only difference? One cashes out every 2 years to take profits. The other leaves it untouched. After 20 years, the first investor has doubled their money. The second has more than 6 times the original amount. Same returns. Same market. Different mindset. That difference isn't math. It's temperament. Because the impatient investor interrupts the very process that would have made them rich. Compounding is fragile. It demands consistency, not brilliance. It rewards those who can endure boredom, those who understand that time is the most powerful multiplier on earth. Benjamin Graham used to tell his students that the market is there to serve you, not to instruct you. He could have just as easily said, time is there to serve you, if you let it. You see, time has no bias. It doesn't care who you are, how smart you are, or how much you start with. But it does demand something in return: patience. And patience is a currency most people can't hold on to. Because in the modern world, speed feels like progress. We measure success in seconds. We scroll. We refresh. We chase instant results. But wealth doesn't speak the language of immediacy. It speaks the language of compounding, slow, silent, and unstoppable. When Graham first taught investing at Columbia, his students were young, ambitious, and hungry for results. They wanted to know which stocks would double fast. Graham smiled and said, "The question isn't which stock will rise. It's which investor will still be standing when it does." He was teaching something deeper, that compounding isn't about finding perfect investments. It's about surviving long enough for the imperfect ones to pay off. He compared the process to planting an orchard. Most people plant one tree and stare at it, waiting for fruit. The intelligent investor plants many trees, tends to them quietly, and walks away. 10 years later, he returns to shade and abundance. That's compounding. Growth that happens not because you forced it, but because you respected time. Let's talk about what compounding really is. It's not just earning interest on your interest, it's a feedback loop of discipline. Every time you reinvest your gains, you're voting for your future self over your current comfort. Every dollar you leave untouched becomes a silent worker that multiplies without complaining, without sleeping, and without your permission. That's the invisible force behind every fortune. But compounding doesn't only apply to money. Graham's greatest insight was that the same law governs life, learning, and even character. Every time you make a rational decision instead of an emotional one, you strengthen your future judgment. Every act of patience compounds into wisdom. Every disciplined choice compounds into freedom. That's why Graham's students Warren Buffett, Irving Kahn, Walter Schloss didn't just become rich, they became rational. Their fortunes were a side effect of their temperament. In his letters, Buffett once called compounding the eighth wonder of the world, misunderstood by most, ignored by many. But Graham would have added something even subtler. The real wonder isn't that compounding works. It's that people interrupt it. Think about it. The average investor changes their portfolio every few months. They panic when prices fall. They chase when prices rise. They destroy the very continuity compounding depends on. To compound wealth, you must first compound behavior, because your portfolio isn't a collection of stocks. It's a reflection of habits. If your habits are impulsive, your returns will be temporary. If your habits are patient, your returns will be permanent. Here's a paradox. The more boring your investing feels, the more exciting your results will be. Because compounding thrives on monotony. The same small, rational choices, repeated over long stretches of time. Graham's style wasn't flashy. He didn't predict crashes or call tops. He simply focused on value, paying less than something was worth and waiting for the world to notice. He knew that time does what emotion can't. It reveals truth. So he waited. He let time prove him right. And it always did. There's a reason every get-rich-quick scheme eventually fails. It violates the one law of wealth that never changes, the law of time. Compounding only works when you trust it. You can't rush it, you can't outsmart it, and you can't cheat it. You can only partner with it. That partnership demands three things: discipline to stay invested, humility to accept mistakes, and patience to wait longer than others are willing to. Those who master those three traits don't just build wealth, they build peace. Let's put it in perspective. If you invest $10,000 and earn 10% annually, in 1 year, you make $1,000. But leave it for 30 years, and that same investment becomes almost $175,000. Now imagine doing that not once, but consistently, decade after decade. That's how fortunes are built, not with speed, but with consistency. Benjamin Graham used to call this rational optimism. He believed that markets will always fluctuate, emotions will always overreact, but value and time always prevail. He told his students, to be an intelligent investor, you must be patient when others are reckless and cautious when others are greedy. That patience is what compounding feeds on. Today, compounding is harder than ever. Not because the math changed, but because attention spans did. We are surrounded by digital noise that tricks us into thinking activity equals progress. But as Graham taught, the essence of investment management is the management of risks, not the management of returns. And one of the biggest risks is losing sight of time. Compounding is invisible precisely because it's quiet. You don't see it daily. You feel it yearly. And because it doesn't provide instant satisfaction, most people abandon it right before it starts to work. There's a story about Graham near the end of his life. A student asked him, "Professor, what's the biggest lesson investing has taught you?" He smiled and said that the real power in life is not control, it's endurance. Endurance, the ability to wait without losing conviction, is the ultimate leverage, because the world will always tempt you to act. But the intelligent investor learns that inaction, when guided by reason, is often the most profitable action of all. If there's one takeaway from Graham's philosophy, it's this: the secret isn't faster money, it's longer patience. Because compounding is like gravity. It always works, but only for those who respect it. Let others chase noise, trends, and hype. You, the intelligent investor, chase time. You build quietly, think rationally, and let the math of patience unfold. And someday, years from now, when others ask how you did it, you'll smile and say the truth they never believed. It wasn't luck, it was time. End quote. Wealth is not built by predicting the future. It's built by partnering with time.